Since 2020, the used car market has undergone an unexpected and profound conversion that has surprised industry experts. Previously regarded as one of the poorest investment choices due to the rapid depreciation typical of vehicles, the environment has shifted dramatically. Today, the market looks like tulip mania. The prices of many used cars began climbing higher and higher, continuing to rise over several years. This trend transformed what was traditionally seen as a depreciating asset into something akin to a cash machine. This surprising turn of events in the used car sector has shifted perceptions and caused many to warn of a used car bubble. One that seems to be imploding as we speak, but not in a way that you would normally think. If we look at the Manheim Used Car Index, which is considered to be one of the most reliable indicators in the market, we can see that wholesale prices for used cars were steady for decades. This chart begins in 1997 until about 2020. It's pretty clear that used cars as an overall segment had very little price variation. Sure, there was a slight uptrend that's visible over a long time horizon, but it doesn't compare to what happened over here. In 2020, this index went crazy, and with it, the prices consumers were paying for many of their favorite cars did too. Let's take one of America's favorite choices as an example, the Honda Civic. In March of 2020, the average Honda Civic in the United States sold for around $13,500. Just 2 short years later, that number was now $21,000. In fact, plenty of people who bought their cars over here, drove them around for 2 years, and then sold them. They were getting more money than what they paid for originally, despite the mileage. Instead of depreciation, we had cars behaving like meme stocks. The Honda Civic is just one of hundreds of examples, but as you can see, that behavior was indeed a pandemic-induced bubble, and we have the opposite happening right now. Prices are on the decline, rapidly falling back in line with historical averages. Today, a used Honda Civic will cost you around $18,000, which is still well above the pre-2020 numbers, but around 20% less than those crazy peaks we saw in 2022. The question is now, is this rapid decline going to continue, and what will it mean for the car industry? To see the signs, let's look back at the Manheim Index. After all, this is a wholesale index, which means it shows what dealers are actually paying for those used cars, and as you can see, it's been on a decline since essentially late 2021. Sure, there have been a few surprise bumps along the way, but the trend line is pretty clear, and if you read into the supply levels, the future doesn't look too bright either. Used car inventory levels, according to Cox, are on the rise. As of early January, the latest data shows that used vehicle inventories on dealer lots have climbed to approximately 2.39 million units. At the end of January, the supply stood at 53 days, which is up from 49 days at the same time last year. This indicates that while there isn't an excess of vehicles piling up at dealerships, the inventory levels are on the rise, and when you align this with the price levels, you can make a pretty safe bet that this trend will likely continue in the coming year, falling back in line with historical averages. This direction is especially pronounced in the luxury segment. Take, for example, a pandemic favorite such as the Mercedes-Benz G-Class. This model's price trajectory is symbolic of the broader shifts in the luxury market. At the height of 2022, a used G-Class could fetch around $181,000. More than 2 years later, the price has tumbled to $137,000, a 25% decline. This depreciation is not isolated to Mercedes-Benz, but is observable across the luxury sector. To further illustrate, consider the Rolex Index, which monitors the pricing trends of this esteemed watch brand. Similar to the luxury auto market, there has been a significant drop in Rolex prices since around 2022. This similar downturn underscores a widespread recalibration of value within the luxury goods market. What you see today is luxury car prices falling off a cliff, while those cheap cars under $10,000 are holding strong, defying the critics and continuing to hold on to this new outlook. Part of the reason we're seeing all of this is financing. Right now, if you go to buy a car, the typical interest rate you're going to be paying is around 12% for used. This indicates that the monthly payments for auto loans are not only inflated due to the post-pandemic economic rebound, but have also escalated sharply with the recent increase in interest rates. Initially, there has been anticipation that the Federal Reserve might reduce rates this year, potentially easing the burden on future auto loans. However, the outlook has shifted. The current expectations no longer foresee rate cuts in 2024. For years now, the talk has been that interest rates have peaked and going forward we would see relief. But as Peter Schiff explained in his last show, this couldn't be further from the truth. The way things are looking now, there actually may be potential for interest rates to continue to rise because we're not seeing the relief in prices that we expected. Take a listen to him explain.
But they don't look at it as any kind of warning. I did hear some people though on CNBC finally saying what I was saying over the last couple of weeks, which is, why is everybody talking about when the Fed is going to start cutting rates or how many rate cuts we're going to have when the Fed should be hiking rates? And so they're now starting to say, maybe we're not going to get any cuts. They're not saying that we're going to get hikes. They're saying no, that's never going to happen. But they are starting to question the validity of the cuts. But nobody is questioning the reality of the fact that they should never have stopped hiking. That's what the rising gold price is signaling, that interest rates are too low and that they need to go up, not just in the US, they need to go up everywhere. The Europeans, the ECB has to raise rates. The Bank of England has to raise rates. The Bank of Japan has to raise rates. Everybody has to raise rates sharply. I'm not talking about, mamby-pamby quarter-point rate hikes. We need 200 basis point hikes. We need serious. The central bankers need to know or let the markets know that they mean business. The central bankers have to let the governments know that they mean business, that, hey, you guys better cut your spending. You can't run these big fiscal deficits because we're raising rates. You can't afford to finance the debt, so you better get rid of the debt by getting rid of the deficits, right? That's what has to happen. That's what gold is telling you, and everybody is ignoring it. So gold at its peak was up about $60 early in the morning. The high that we hit was about 2,430. That's already better than a 20% move above 2,000. So we are way above what used to be resistance.
So as you just heard there from Peter, there is some serious evidence pointing to the fact that rates could even go up from here, and with consumers already struggling to afford these inflated prices, this continued pressure by the Fed will eventually bleed into the used car market and these prices will fall back in line with historical averages. My prediction is that the Manheim Index will continue its current downtrend, reflecting a broader recalibration within the used car market. While most experts agree that prices are unlikely to fall below the lows we observed in 2020, there is a general consensus that we are heading towards a significant realignment. This shift is expected to gradually restore a sense of normality to the used car market over the next few years. Let me know what you think of the used car market in the comments below, and don't forget to hit that like and subscribe button if you enjoyed the upload.